everybody, it's Dave. It's March the 6th, Friday. We had another week of thrills and spills. Today the market started up, actually 140 points was the high in the Dow. Then it got down to a negative 140, and then we had the stick save into the close, as many people just don't want to be short going home over the weekend, and maybe there's some kind of surprise. Greg, what are your thoughts on that?
Just another week of market violence that we've come to expect, where the Dow was off 7% for the week, so that was the worst week since November. You wonder, this last minute action today, I mean, there's a lot of short covering, as you say, because people who had made a bunch of money this week were probably putting some of those, bringing a register on a little bit of that. And then you also have, in this market environment, you sort of wonder a little bit whether someone got the word that there's going to be some more shock and awe about 8:30 on Monday morning. I mean, I certainly haven't heard anything like that, but unfortunately I'm not in the know. So
you mean they're not consulting you, huh?
They are not giving me the phone call. So some interesting things out there, though. Our stick save apart, Goldman Sachs was down 7.5%, and that's often looked at as the canary in the coal mine for a lot of people. I don't know what's going on there, but whoever owned it decided they didn't want it anymore today, big time.
Yeah, somebody I know sent me an email, was talking about insurance companies, and that if you had any cash value in your insurance companies, you should borrow against it right away, because there's probably going to be a run on insurance companies, whole life and universal life and that type of thing. I was pretty shocked by that. And then that same person also was indicating that perhaps Berkshire Hathaway, given their terrible problems with both insurance and financials, and the fact that they sold all these puts on the market, that they're down billions and billions of dollars on these puts that they got involved in. Have you been hearing anything about that?
Yeah, anybody who's interested in the Berkshire derivatives story, Buffett's letter came out last weekend. He explained it pretty fully. I mean, anybody looking at that and sort of saying there's good reasons to be short Berkshire, and I wish I had been 6 months ago, but he's got a very good story. I mean, those famous 15-year puts or whatever they were he's sold are down big time, but he's taken in $5 billion of premium, and he doesn't have to put up any collateral. Over-the-counter deal, he's not collateralizing them, and he's got the $5 billion to play with for the life of those contracts. He may be wrong, he may be right. The focus on that particular aspect of his business is, in my view, totally misplaced.
What's going on with GE? GE was up today. Was flirting with $5 at one point this week, as I recall, or $6 anyway.
Yeah, well, GE's just like all these other financials. A lot of the big banks, what do they call them? The fortress banks. Forget Citi, but JP Morgan, Wells Fargo, a lot of those guys were off 30% this week.
Yeah.
The big problem with all those, either the financials or the closet financials like GE, is that nobody trusts them. Nobody believes the marks they've got in their books. And, I mean, Wells Fargo is a classic. Increased its dividend last July, got a huge pop out of that. They've been talking about their dividend being strong all the way, and then today they cut it by 85%.
Right, yeah.
As with JP Morgan earlier in the week, their stock immediately went up on that. So,
nothing like bad news, I tell you.
I mean, GE, the chief financial officer, made some happy talk yesterday, and he says they don't have a problem, but he's been saying they don't have a problem for months now. They've been saying that their dividend was as safe as houses, and then they cut it this week. Now, these financials cutting their dividend is, as far as I'm concerned, what they should have been doing months ago just to conserve their capital. They've been making all these statements about how they wouldn't cut it, and then they do. Is it any wonder? Who do you believe, me or your lying eyes?
Which is the only thing I believe is the tape.
Yeah.
Moving on to bonds, our portfolio at DSP is like, one thing's going up, the other thing's going down. I can't get any traction going. I said yesterday that bonds are trading like pork bellies in a bad weather market. And they have been. One day they're up a couple of points, next day they're down a couple of points, and they just can't seem to settle in on a trend, even though I believe on the long end, the TBT and so forth that we're invested in, and TLT and so forth that we're short, that the yield curve has to steepen. And it probably will at some point, but we have all these little flights to safety, which really goes right to bonds. We're just hanging in there, folks, with bonds, and that's what we'll probably continue to do. We did okay today. Same has been true with gold. Gold has been doing really well, and then all of a sudden the last 3 weeks they took a lot of that back. And I'm not particularly worried about it, but it's just frustrating that we get any traction going with some of these things. Same is true with the dollar. The dollar is strong, and then it's not strong. The European Central Bank cuts rates. That should be a sign of weakness for the euro, but they bought the news for it. Very difficult to get these trends really going.
Yep, and that's what we've seen for months now. And I mean, personally, in my own book, I am doing very little. I didn't trade once this week. Every time I look at my positions and say, okay, I have profits here, what should I do about them? I keep a fairly balanced book. I'm a little longer, in fact, because most of the trading I have done this year has been trimming shorts. Just looking at my book, if I'm going to take something off the short side, I also want to take something off the long side. I look at my options and I say, it's moving around. If your book's the way you want it,
yeah, that's right. That's right.
You might as well sit on your hands. One of the things I've learned over the last few years is patience. You have to let it come to you. And I don't know how many times I thought of buying some Citi at $7, $5, $4. I didn't, and I'm glad I didn't.
Somebody was saying on the radio this morning that for $6 you could buy a share of General Motors, you could buy a share of Fannie Mae, you could buy a share of Freddie Mac, you could buy a share of AIG, and you're going down to Citigroup, and you'd have a portfolio of each share as a total of $6, which is really extraordinary. I got an email today from a pretty good guy in commodity markets, and he said to me, isn't it shocking what's happened to our markets? And it is. And financial advisors, small money managers, big money managers, do-it-yourself investors, people trying to fund their 401ks and IRAs, people are pretty much shocked by what's taken place, and this is the worst bear market I've ever seen in 35 years of being in the business. And it's worldwide. I don't know when it's going to end, but there's nothing wrong with holding cash for a while until, as you say, the market comes to you, whether it's to be long or whether it's to reshort. And that's what we're going to do. Now, next week, Greg is not going to be with us. He's a contrarian kind of guy. So he is moving down to Florida when everybody's coming back up north, and he's moving from Connecticut. So we wish him well on his travels and move. Greg, thanks for being with me.
My pleasure, Dave. Thanks, everybody. And if this goes well enough, I'll be back in a couple of weeks.